The United States economy has become more interest rate sensitive than at any other time in its history. The amount of debt that was taken on in the post-COVID era is absolutely astonishing. And so to begin raising interest rates in this environment is not just a normal walk in the park. This is going to be extremely challenging for the Fed. We're beginning to see the stock market, really begin to sell off. The indices are still pretty high, but if you look at some of the internals, like in the NASDAQ Composite Index, for example, there is some major carnage in tech stocks and growth stocks, and a lot of this has to do with fears of what the Fed is going to do.
This week's special with Miles Franklin Precious Metal Investments. 1 ounce silver buffalo rounds for only $2.99 over spot. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Jerry Robinson from followthemoney.com. Jerry, thank you so much for joining us today.
It's great to be here. Thanks, Elijah. Always enjoy it.
You mentioned in a recent podcast that when it comes to the stock market, as January goes, so goes the rest of the year. So as we're seeing, a lot of the stock market indices making all-time highs, what does that signal for the stock market for the rest of 2022?
It's really interesting. So the name of that podcast episode was called the January Barometer. And that's actually a phrase that was adopted by Yale Hirsch, who is a well-known, well-respected stock market analyst who has passed. Jeffrey Hirsch has taken over Yale Hirsch's research, his son, and they put out the Stock Traders Almanac. So many people are probably familiar with that name, maybe not the Yale Hirsch name, but or Jeffrey Hirsch, but the Stock Traders Almanac, just a wealth of information. And I've used it for years. But on the latest podcast episode, I wanted to remind listeners of the very interesting correlation between how January goes and how the stock market goes overall. Now, it's not bulletproof. Sometimes it fails. But, since 1950, the so-called January barometer has been right about 84% of the time. So what that means is that if the month of January is up, then typically that bodes well for the rest of the year. There's also something called the January trifecta, which is not just the barometer, which measures the whole month and says, how is that going? But also it looks at the first 5 days and says, how did those do? And if those do well, that also can be indicative of the rest of the year. And then there's also the Santa Claus rally, which is kind of completes the January trifecta. And so anyway, we really just spent some time kind of talking and breaking that apart to help people see. So right now, the market, of course, has been under pressure in the month of January. So the first 5 days weren't that hot. And the month of January remains to be seen because we're still just, a third of the way through. But when the month is over, it'll be interesting to see, how that, January barometer works. But right now, I would suspect, and this is early, and I have no crystal ball, but it's hard to imagine that the Fed, the Federal Reserve, is going to allow all of the financial markets simply just to fall and just keep falling. The market is simply repricing risk. It's beginning to price in potentially 3, maybe 4 rate hikes. It's difficult to imagine that the Fed does that. That's what I'm saying, Elijah. It's difficult to imagine that the Fed is going to do what it says it's going to do this year. So anyway, that's probably a whole nother question, but that's what the January barometer is. And they can listen to the latest podcast episode, followthemoney.com. Check it out. It's really quite interesting.
The Fed is saying that they're tapering twice as much as usual, and they're going to end their quantitative easing program early. Also, those 3 rate hikes that they're considering this year. Why are you skeptical that will actually happen, and what would it mean for the stock market if that does happen or if it doesn't?
So just to back up slightly, some banks have been calling for at least 4 rate hikes. And I believe JP Morgan or Goldman Sachs, one of the two, is forecasting that we'll see 4 rate hikes, not just 3. The Fed has telegraphed 3. Okay, so we are currently in a near zero interest rate policy, right? We've been near zero for a long time. And when you look at the average interest rate over time, if you go back for the last, say, 3 or 4 decades, you'll find that the median interest rate was this is the Fed funds rate, was 5.67%. 5.67% is the average rate for the last 3 or 4 decades. Now, what's ironic is for so long, Elijah, we've heard about how great the economy is, right? This is the greatest economy ever. I mean, we heard that, a lot of the chest beating. Oh, that was the greatest economy ever with 0% interest rates. It makes you wonder how strong the economy is if you raise the interest rate, let's say to 5%. How about we just go back to the average or the median interest rate of 5.67%? Would we still have the greatest economy ever if we had just average interest rates? And the answer is no. In fact, where we are right now, I would suggest is that the Fed, after analyzing this stuff for more than 2 decades now, I would suggest that the band that the Federal Reserve is working within as far as the interest rates is that they have anywhere, say, negative 1%, all the way up to about 2.5%, maybe 3% if they just want to spook the markets and then bring it back down. So the band that they have to work with is very, very small. So what I'm saying is that the Federal Reserve, it only has a couple of buttons that it can push. One button is to make money easier. The other button is to make money less easy. Right. So that is raise interest rates, lower interest rates. That involves printing money and all of this. Now, the Federal Reserve is kind of desperate in the fact that it's pushed the button that has lowered interest rates, and it's created all of this massive, widespread inflation in addition to other problems as well, not just the Fed. And the Fed now is caught in a problem because if there's another issue that pops up, what can the Fed do? Can they lower interest rates again? No, they can't lower interest rates any more than they are. They could stop tapering and they could start buying more. I mean, that's all they can really do. So the Fed, what it always does, and anybody who's been investing or trading for any length of time, and you've been watching the Fed, you know this, they vacillate between, pushing this button and that button, boom, bust, boom, bust. So what they're doing is they're trying to get enough ammunition in their gun by raising rates and getting less easy money policies out there so that they can do it all over again. Because inevitably in this kind of boom bust economy that we're in, which is largely driven by the Fed is going to need that ammunition, and they don't have it right now. So we're sailing into, what could be an uncertain year, and the Fed has very little leverage. So the Fed needs leverage, and they're going to raise rates, so they have that leverage. Now, the reason why I question whether they're going to raise interest rates is because the United States economy has become more interest rate sensitive than at any other time in its history. The amount of debt that was taken on in the post-COVID era, the amount of debt that was taken on by corporations, by consumers, and of course by governments is absolutely astonishing. And so to begin raising interest rates in this environment is not just a normal walk in the park. This is going to be extremely challenging for the Fed, and they may not be able to raise as high as they want to go, and they may not be able to do it as quickly as they want to do it. So when the Fed says something, it's telegraphing to kind of put its finger in the wind to see what the investors, are going to say. Kind of dip the toe in the water, maybe is a better illustration, to see what's going on. And right now, when the Fed says we're planning on 3 rate hikes and we're going to make money less easy, we're beginning to see the stock market, really begin to sell off. The indices are still pretty high, but if you look at some of the internals, like in the NASDAQ Composite Index, for example, I mean, there is some major carnage in tech stocks and growth stocks. And a lot of this has to do with fears of what the Fed is going to do. The Fed hasn't done anything yet. I mean, it has accelerated its taper this year, but it hasn't completed its taper, and it hasn't begun raising rates. So it's all talk at this point. And therefore, I just don't know how much I believe the Fed is going to raise interest rates that aggressively, knowing how interest rate sensitive the entire economy is. They know more about that than I do.
So it seems like what you're saying is that the Fed is they don't have any way to ease any more than they already are. So they're looking to raise interest rates and stop tapering. So if the time comes where they need to save the markets, they have that ability to do so. We hear a lot of people talking about the stock market being extremely overvalued, but it keeps being propped up by the Fed. So your perspective on that, will we ever see a crash for the stock market? Or is this the new normal of just the Fed easing in the stock market continuing to be at all-time highs?
Stock market's always too high. There's very few times when people look at the stock market and say, boy, this is a discount, right? Very rarely. I mean, maybe parts of the economy, maybe certain sectors. But normally, under normal circumstances, every year the stock market is too high, according to analysts. Go back to 1986. There were people who were talking about how high the stock market was. You go back to 1993, and you hear about how high these stocks were. In 2011, the stock market was overvalued. In 1972, the stock market was overvalued. So in other words, we live in a perpetual overvalued situation. That's just kind of where it is. So we have to kind of be used to that. There is an idea that somehow because the government is bankrupt, somehow that means that Apple has to crash and go to zero. Well, it would be an incorrect statement. Apple could outlast the American government. ExxonMobil could outlast the United States government. In fact, they probably will. Chevron could probably outlast, they operate in 190 countries, so there's many corporations out there that I believe will actually outlast the United States. And so I'm not as concerned about well-run corporations that may have excellent revenues, diversified across the globe. Think of something like Coca-Cola, or think about something like Apple. Think about something like Pepsi, Cola. These are all, Pepsi's at a new all-time high this year. Coke's at a new all-time high this year. Consumer staples have been hot because people have been, looking for quality stocks, value stocks in this environment. But I'm not as concerned about, high quality stocks in this environment as I am about, what happens to our money, what happens to our currency. We're living in a time of great inflation that causes the price of all assets to rise over time. And I simply think that if you're going to be in the stock market, you should be in quality stocks, right? Forget growth, forget value, think high quality. It's the same thing if you're going to be in mining stocks. A lot of people want to gamble on, stocks that don't have any income or anything, and they're gambling on hope. If you're going to be invested in mining stocks, be invested in quality mining stocks. They're out there. So I would say, if you're going to be in the market, be looking at quality here. There's going to be a lot of great opportunities going forward, but quality is where it's at if you don't want to get hurt over the long term. Now, if you're a trader, if you're like, I'm going to buy a stock and I'm going to be out in 6 weeks, you're probably going to lose money. Who knows? But if you have a 10-year time horizon, 15-year time horizon, focus on high quality companies that make money and that keep part of it every single month. That's known as net profit or earnings. And make sure the companies you're investing in can weather these kinds of storms.
Can you expand on what really makes a quality stock? I mean, you mentioned geographic diversification so that, if the U.S. goes under or goes bankrupt, then this won't impact the company too badly. Can you expand on that? What does it mean for a stock to be quality in your mind?
Well, quality to me would obviously be globally diversified. So you're not dependent upon only one country. Also that you are growing revenues and you're growing earnings per share on a regular, consistent basis, and you are lowering your shares outstanding. Now, what that means is that you are thinking first and foremost about running a very high quality company. So you're squeezing more money out of every dollar that you earn. So earnings are going up. You are making more money. More money is coming into your cash register. Therefore, revenues are going up regularly. And then on top of that, the amount of shares that are outstanding, you're not inflating those and diluting shareholder value, but you're actually lowering the number of shares outstanding, either buying back your stock or using some other way to lower the shares outstanding. So you actually boost shareholder value. I would say those are the kinds of companies I look for. Apple is a perfect example. I've been a long-term holder of Apple for a long time. I think they do very well. Apple was $1 trillion in market cap, I think, back in 2019. 2018, somewhere in there. It's now $3 trillion or near it. It recently touched it. So it tripled in value. How? In the middle of COVID, it tripled in market cap because it is well run. Many companies didn't know how to handle COVID. Apple was able to navigate in the COVID era and actually triple its market cap maybe double, but triple over the course of the last 4 years or so. So high quality companies know how to raise revenue on a regular basis. They know how to raise earnings on a regular basis. They know how to not dilute shareholders by putting out too many shares. And then there are also a whole nother slew of internal fundamentals we check. We don't have time to get into today, but I would say those would be the main highlights quickly to be able to focus on.
If we look also at commodities and we look back at last year, we had a huge run in many commodities. Unfortunately, not gold and silver. It seemed like gold and silver didn't do very well in 2021. But your perspective on that difference we saw between the performance of gold and silver and other commodities last year?
Commodities. It's funny. Barron's magazine has on its cover for the January 9th issue, I believe, January 8th, January 9th issue. This is this week for 2022. It says it's time to buy commodities. Right. Well, maybe so. We did a podcast, about a year ago talking about how the commodities bull market is coming. And of course, 2021 was a great year for commodity investors. I mean, coffee prices, hit a decade high after doubling in 2021. Sugar prices hit a 5-year high. Lumber prices hit a brand new all-time high. Anybody who's been building knows about lumber prices. Oil, natural gas, many of these different types of energy sources, they all rallied strongly on the year. Wheat hit a 9-year high last year. Oat prices hit a record high, doubled in price last year. I mean, you could really look at many soft commodities. You could look at many hard commodities last year, and you could see that, prices were up dramatically. We expected this, and we were helping our members all through the year staying on top of this. In fact, our members knew about rare earths, lithium, water, many of these commodities that just did fantastic throughout the year. Well, followthemoney.com points our members to leading markets, so that's what we do. So we keep our members on the cutting edge. One of the things that was down near the bottom, as you mentioned, during the whole year, except for the very beginning of the year, there was a little bit of a blip we had toward the beginning of the year, and I think also in the middle of the year briefly, was gold and silver. But at the end of the year, gold had fallen 3.5%. Silver was down, a little more than 11%. Palladium was the really big loser. It was down around 20% year to date, or in 2021, I mean. That was after Palladium put in an incredible rally. I mean, we called the uptrend in Palladium back in 2016 for our members and then never retracted it until 2021. So, I mean, that thing ran for 5 years with an uptrend, and it was an enormous return. Well, it had a 20% down year last year. And so, that's pretty bad. But at the same time, after you consider the huge run that it had, it was incredible. Platinum prices were down about 10% year to date. So it is interesting because you did have this huge push, as you well know, Elijah, in the retail space, trying to push and boost silver in the retail space, right? So there was this big excitement in 2021 among silver investors that retail investors were finally going to break the back of the banks. They were going to finally be able to push prices beyond the price manipulation. Well, that didn't happen. And didn't happen hardly at all, in fact. When it did, it was just briefly. So gold and silver were not the only things that didn't do well last year, but they were notable in the fact that you think to yourself, how can you have a headline that says inflation is at a 4-decade high and have gold down that year? It's just really bizarre. There are all kinds of reasons. There are people who are smarter than me on this, who would probably have something better to add. From my perspective, from where I sit as a gold and silver investor, I invest in hard bullion. I don't invest in mining stocks. I don't invest in any. I just own the hard bullion as insurance over time. For me, I actually enjoyed the price depression somewhat because it allowed me to continue buying more at good prices. That's how I view it. I'm a longer term kind of guy when it comes to that. But some people were upset, that we didn't see that move up. The way I look at it is that if you need to cash out, then you want prices to go up. But until you need to cash out, I would prefer for prices to be flat or to go down so that I can accumulate more, especially if it's something like gold or silver. So as we head into the new year, I really like platinum. I think platinum is got a really compelling story. I also like physical gold and silver as well. But again, that's going to be very dependent. Their prices are going to be largely dependent, I would say, upon how serious the Fed is with its 3 rate hikes promise or vow. Difficult to know what's going to happen, but those are my thoughts.
So this year you are bullish then on precious metals?
I think that platinum, palladium may still have a little bit of ways to go down because it's had such an incredible run for so long. But I would say platinum and gold and silver, these 3 are the ones that I really think probably stand out to me this year. And also high quality miners might do well as well in this environment. I do like it for this year. I do. I almost have the opinion, Elijah, that once everybody kind of throws in the towel and says, "Oh, I guess it's not going to go up," that's when it's going to go up. There's quite a few markets like that. There are many markets that are high quality. The supply-demand fundamentals are intact, but the prices are down. So there is a little bit of irrationality that's going on right now, and of course, that's been driven by Fed policies that are irrational.
Can you share a bit on why you prefer the physical metal versus the mining stocks or any other kind of electronic form of the metals?
Well, it's not that I don't like mining stocks. I think mining stocks are fine. I think they're a lot better than they used to be. Mining stocks for a long time were notoriously fundamentally terrible. I mean, they were run by, people who didn't care about, shareholders, and they spent too much, and it was just, garbage, balance sheets. Over time, we've seen that change. We've seen a lot of good things kind of move into the mining space. Mining is a very specific and particular kind of market that's a niche. Now, I have invested and traded in the mining niche before, but the problem with it is that you have to stay on top of it at all times. So you can't just pop in and out of markets and assume you know what's going on. Like, you have to kind of focus on a niche. This is what we teach our members. And many of our members have a niche of precious metals. So they focus on that. They study that. They understand it. They know the good miners. They know the bad miners. They know the profitable miners. They know the unprofitable miners. They do their research. And then once they've done that, then they go in. For me, gold and silver physical that I can hold in my hand, that makes sense to me. I understand it. Miners do too. But if you're not specializing in it, if it's not your niche and you're not studying it regularly, then you could lose a pretty big chunk of change. So it's a specialized market that I think people who they want to go into mining, fine, spend time researching it and do your due diligence. But if you just want exposure to gold and silver, then the physical does it for me. That's how I do it.
Now, one last topic I'd like to discuss is the recent trade partnership that is actually one of the largest ones the globe really has had. It's called the Regional Comprehensive Economic Partnership. And although the mainstream isn't reporting a lot on this, you did in your recent podcast. What do you think the significance of this is for the global economy?
Well, this is huge. So, RCEP, as you mentioned, the Regional Comprehensive Economic Partnership, this is the largest trade agreement in the world. It took effect on January 1st. You didn't see it on CBS, NBC, CNN, Fox. They don't care about this stuff. Or they do, but they don't pay attention to it for us. Maybe we don't care about it. That's why they don't show it on TV. But we should care about it. The largest trade deal in world history just took effect January 1st. And guess who's not in it, Elijah? United States, right? So you have China, you have Japan, you have South Korea. You have many of these other Asian nations who have created a new trade agreement that basically eliminates tariffs on 91% of all of the goods in that area. It's a trade deal that sets up trade in Asia for Asia. And as I mentioned recently, this RCEP covers 15 countries, nearly 1/3 of global GDP. It covers more than 50% of the world's exports, and it covers around 2.3 billion people, right? So this is absolutely enormous. And the United States has just missed its chance over and over again to be able to compete in this area. So they missed out on the ability to create the new Silk Road. They were too busy bombing Afghanistan. We still don't know why, aside from natural resources. Instead of going in and working peacefully with China's neighbors, we were over bombing Iraq. We're still trying to figure out why that was going on as well, aside from natural resources. So while we were bombing countries and going trillions into the hole for our warfare state, China was busy making friends and influencing people and creating trade deals and commerce. This is how you win. So the United States is well behind. It's a day late, dollar short, as usual, behind China. China has a larger economy than the United States, and many people are upset at China because it's communist. They're upset at China because it's communist and it's beating the United States. That's almost too much for the American head to. The American mind just can only take so much. At some point, to hear that the communist nation has more GDP than you and is growing faster than you causes the capitalist U.S. mindset to explode, right? They don't really know how to handle it. So when China officially becomes larger in GDP on a nominal basis as opposed to PPP, which it already is, that's going to Americans are going to find that out. They're going to find out that China is larger than the United States. One night it'll come on your TV screen, right? It'll be a terrible headline. China is larger than the United States on a GDP basis, specifically on a nominal basis. Well, that's a problem. And the fact that the Chinese are not a democratic government, the fact that they're not pure capitalists, the fact that they have capitalism with socialistic characteristics or whatever, state characteristics, this is too much for the American folks to handle. So I can see in the future, not just a Cold War, but a hot war between the United States and China. We talked about that on that latest podcast you were mentioning about the old Thucydides trap. Graham Allison wrote a great book. But the Thucydides trap is this idea of an emerging nation and an existing nation that is a current world power and how those two interact. And too often times it leads to war. China's emerging, the United States is established, and the United States is not in any mood to lose the number one trophy. And so if China takes it, we'll just have to see how the American people handle that, how Washington handles it. But historically, that usually leads to pretty seismic tensions.
And how do we prepare for such an event? I mean, it seems like one way is to diversify geographically with investments, right? As we mentioned at the beginning of this interview in stocks, but your perspective on as we see the U.S. declining, and we've talked about this for a while, and you've been reporting on this for so long that you see China as, the next largest economy. So your perspective on that, how do we prepare financially for this event?
Well, again, it boils down to diversification. When people say diversification, sometimes it confuses people because people like Warren Buffett, for example, will say, the only people who need to diversify are those who don't know what they're doing. That's understandable, and I agree with Warren Buffett on that topic, even though I say diversify. And what I mean is this: when I say diversify, I mean across various asset classes. Now, it doesn't mean that if you're going to invest in stocks that you don't specialize in a niche and maybe go more heavy in a particular area that that makes sense. But what I mean by diversification is not, owning Coca-Cola, and Walmart and all these different stocks. That's not diversification. Diversification would be having stocks as one of the financial drawers that you have. But then you also have other things like you brought up earlier, physical gold, physical silver, right? Physical metals. You can also have things like, other types of commodities. You can invest in physical real estate. Some people don't like physical real estate. Fine. Then choose another drawer. But the point is, don't put all of your money into one single drawer and think it's going to be safe there. There's no such thing. There really isn't. Those who would say, well, I'll put all my money into gold. Well, good luck with that, right? Just have a good time with that, because you're going to find out that the government can change the rules at any time, like it did back in 1933. Maybe say, I'm going to put all my money into real estate. Real estate always goes up, and Will Rogers said that they're not making any more land, so I'll just put all my money into real estate. Well, you'll find out real quickly that property taxes and the IRS rules, tax rules, can change, and you can be in a world of hurt. So what you want to do, the best way to plan for an uncertain future is to have your money in different drawers, a little bit of stocks, a little bit of commodities, a little bit of real estate. How about starting your own business or investing in someone else's business, right? So different kinds of assets going on, working together like an orchestra. If you went in to see an orchestra and all that was on the stage was a flute player, you'd be like, this is a sucky orchestra. You don't like this orchestra. But if you go into a orchestra hall and there's many different instruments playing together, they sound beautiful. And that's what a good portfolio is. It's some of this, some of that, all together. And if something happens to this one asset class, because say the stock market crashes, well, you're not going to be living under a bridge because you have other assets that you can draw from. So that's what I mean. And we teach how to do that. Obviously, that's a very big topic. We teach specifically how to do that here at Follow the Money. We teach exactly how to diversify. We teach 22 different income streams that people can create both now and in retirement. We teach how to diversify. All of that stuff is here. We educate and equip and empower individuals for uncertain times. And so that's what I would say. There's a lot more to say. I could add to that, but let's just leave it there.
Definitely. And if people are looking to get their membership at followthemoney.com, we have a promo code Liberty, which will get them 10% off, or they can follow the link in the description of this video, our affiliate link. So you'll be supporting Liberty and Finance along the way as well. Any last thoughts you'd like to leave with our viewers? And if you could share a bit about the membership.
Sure. Yeah. Well, I would say for those who are listening, if you like what you've heard today so far, go check out our free podcast. We have followthemoney.com. Just click on the podcast link. We have several different podcasts. We have one on stock trading. We have one called Follow the Money Podcast. That's one we've been talking about today. We have others as well. But go check out our free podcast and see what you think. You can go to followthemoney.com. You can sign up for our email list. And then for the memberships, I'm so glad you brought that up. We do have a 10% discount, especially for your folks, but they have to enter that coupon code Liberty at checkout. And that will give them 10% off of their membership. The memberships, no matter what you're looking for, we just released a few different new products in 2022. One of them is a crypto leaderboard. So anyone who is interested in cryptos, this one is a hot service that many of our folks like. We have an ETF leaderboard that's new in 2022. Keeps you posted. We track commodity ETFs and global ETFs and many different ETFs to help you stay on top of the hottest markets. We have all kinds of stuff. Plus, we have ongoing video coaching every single week with myself, where you can come and ask questions. It's a great service, and I'd love to help any of your folks. Just simply go to followthemoney.com and enter in that coupon code Liberty when you get to the checkout. Love to see you on the other side here.
Fantastic. Well, Jerry Robinson from followthemoney.com. Once again, thank you so much for your time, and God bless.
Bless you, brother. Take care.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. 31 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded for physical delivery, vault storage, or precious metals IRAs. Excellent prices, privacy, and confidentiality. Pay by check, money order, ACH, bank wire, or Bitcoin. Satisfaction guaranteed. For fastest service, just call 1-888-81-LIBERTY. That's 888-81-LIBERTY. And either I or one of my sons and fellow brokers will call you back as soon as we can and understand your needs.